Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar. My name is Shishir. I write on micro and macroeconomics for the Hindu Business Line. Welcome to the latest episode of the State of Economy, where we are going to talk about how the economy is doing and what kind of prospects are there. To talk about more, we have with us Radhika Rao, Executive Director and Senior Economist with DBS Group Research. Welcome to the show, Radhika.
Thank you so much, Shishir. Happy to be here.
Radhika, my first question to you that we have two high-frequency economic indicators during last 3 days. One is, of course, the PMI manufacturing, and the next one is the GST number. If we see both the numbers, PMI manufacturing at 57.8, GST collection in the month of June, it was 1.61 lakh rupees. Can we say that the consumer demand is picking up?
So let me begin with the GST number. Like you rightly mentioned, it came up about 1.6 trillion. And this number was about 12% higher than the comparable period year ago. And I think if I were to take the year-to-date monthly average, it's again about 12% higher than where we were in fiscal 23. But fiscal 23, of course, the earnings were even more. That grew by about 20% year on year. Why is JSD generally doing well? I think it's certainly reflects stronger demand. Besides that, it's also the steps towards better due diligence, as well as some price effects, basically reflecting inflation as well. And I think we are meeting at a very interesting point because as of end June, GST has completed or marked its 6th year being in functionality. So the architecture, as well as the mechanism, has certainly strengthened over this period. And we've got not only better compliance, but also more taxpayers under its fold. And I think all of this is underpinned by a layer of digitalization, all the way from, I think, registration to refund, e-way bills, e-invoicing, and the mix. So overall, I think the mechanism, unified tax structure continues to strengthen. There are still some areas where improvement is sought, but I think overall, insofar as collections are concerned, from below 1 trillion about 3-4 years back, we are well in the 1.5, 1.6 trillion kind of range. And the latest number, again, bodes well for consumption and demand in general. Talking about the PMIs, PMIs, I think, are a better indicator of what manufacturers as well as service providers are facing. I think PMIs in some ways is like a confidence survey. And of late, we have seen that India's PMIs in particular have been exceptionally strong. In fact, if I were to look at the last 20 months, in this 20 months, it's been above 54, and a good over two years plus, it's been in the expansionary region. Again, manufacturers tells you that the confidence is strong. Input prices have also begun to come off, so the pressure to pass it on to output costs is also lower. And I think here I will also draw upon what's happening in the region as a whole. So when I talk about the region, I mean Asia 10. And the countries that are under our coverage, when we look at it, in fact, PMIs have been losing momentum. Some of them are still in the expansionary terrain, but month on month, it's been slowing. And in fact, the latest reading, if I were to see, out of 7 countries, 5 have declined. And some of it is, I think, also reflective of weaker export performance. So coming back to our PMI, certainly holding up in expansionary terrain. It's a bit slower than the month before. But again, I think that could be put to month-on-month fluctuation and a pretty strong reading at that.
Okay. Now the next high-frequency economic indicator would be the retail inflation, the number which will be out 10 days from now. What is your expectation?
Market observers certainly look at the number very closely. And much more because we've had 3 years of above target range inflation. Thankfully, the cycle seems to be turning down. We have had inflation readings this quarter, which have been coming back into the range. In fact, if I were to talk about the June reading, that should be out soon. We expect that to be below 5%, just like May. And what's that telling us? Of course, base effects are quite significant. Same time last year, we had seen quite a strong increase in commodity prices, and that had driven inflation numbers. So that's benefiting this year's readings. But even if I look at the next 2-3 quarters, we do think inflation is going to range around the 5.2% kind of handle. For the year, we have a forecast of about 4.8%. Now, CPI is easing, WPI is easing even faster because of the weightage of tradables. But if I were to talk about risks as well. Certainly, weather is number one, and commodity prices is number two. But commodity prices in general, especially energy and oil that matters to us, that's been very well behaved. In fact, it's lower than what the RBI's own assumption is. So I think that is something that's beneficial for inflation. But of course, the joker in the pack, is what happens to weather. Overall, in the year, we have 4.8% average with some upside risks based on how weather pans out.
Okay, since you talked about one of the risk factor, that is the monsoon, and since we just got the news that the monsoon has covered entire nation, so do you see much more impact on the food prices as well as on the fuel prices because of the monsoon?
Certainly, it's interesting you asked that, because that is a very, very important development that is, routinely in this part of the year. Once June comes upon, first of all, the onset of monsoon, second of all, how fast it's spreading geographically becomes quite important. And we started off with a slow onset, but thankfully, what we have seen is that monsoon has covered ground and covered ground very fast. In fact, the IMD had also come out recently to say that in past more than 2 decades, there's been only 3 years, when this has happened, where monsoon has gained ground so fast into early July. Nonetheless, I think ahead of this, certain vegetables, for example, has already risen, some cereals as well, and that reflects worries over the delayed Kharif sowing last month in June. So coming back to the monsoon, it has spread. Again, June is important. July is even more important, because July, August covers about two-thirds of the overall rainfall. So it needs to be not only onset fast, but also spread well, especially to in agriculturally important pockets like UP, Bihar, and some of the southern belts, Punjab as well. I think the progress is encouraging. We would look for its spread and how fast it's able to cover some of the low irrigated areas in particular. And IMD also had mentioned that El Nino worries have not really impacted June, but July we might see more of a fallout. If we were to talk about where the central bank is at this point, in fact, the central bank's own prognosis is that weather could add about 50 basis points, not just the southwest monsoon, but bad weather in general. Because if you've seen intense heat waves and all of that, potentially could add 50 basis points of upside risk to inflation. So wrapping it all up, I think monsoon certainly a big watch factor. It's very encouraging that it's spread and spread fast, especially the onset and geographic spread. But we would be keen to see if the intensity as well as crucially important farm belts are also covered. And this happening at a time when El Nino onset would be deeper as well.
Okay. Radhika, if I add one more question to the inflation, that is the top inflation, which is the tomato, onion, and potato, which is the currently hotly debated topic, especially the tomato one. Do you think that it is just a small factor, or just is going to improve in coming, say, 15 days or 30 days, and we will have a better vegetable inflation?
Vegetable inflation is perhaps one of the most volatile inflation. It swings quite hard, and it reacts a lot to adverse weather conditions. Now, out of the top that you mentioned, I think tomato has certainly been in a huge point of discussion, mainly because there was a swing in way production was handled. If I were to see earlier this year, prices had in fact crashed, and because of which some of the farmers are farming states where this is grown much more, in fact, did not go ahead and even harvest because the receivables were not as high. And now look forward, when we bring this whole thing forward, now there is a supply crunch, and supplies that are hitting the market, which should routinely have been harvested and should have been supplied, that has not come because it wasn't harvested at the right time. So I would think among the TOP as of this point, tomato seems to be more persistent. And I think vegetable inflation in all, as the Kharif sowing happens, you routinely picks up as well. So seasonally a strong period as well. So it hasn't really upset the apple cart, so to speak. But yes, I think seasonal strength in this pocket of food inflation, plus tomatoes in particular becoming a much bigger topic of discussion, I think will hold vegetable inflation higher. Base effects might nullify some of that. Low energy prices might nullify some of that. But we do think it will percolate through food inflation over the next 3-4 months.
Okay. There is a discussion that rate of interest, because of the inflation, has come down. Rate of interest has picked up. So can we see within next 6 to 9 month rate cut? Can we talk about this possibility at this moment?
Yeah, every central bank, I think, is weighing two things. Firstly, I think, are we at the peak of the rate hike cycle? And secondly, is it time to pivot towards easing? And when you look at some of the Western central banks, they're telling you that each time they've entered a pause, it hasn't mean that they have closed the door to rate hikes. In fact, we have a good few examples of major global central banks who have come paused and then they have gone on to hike rates even more. Now, against this context, where do we see RBI? I think RBI essentially is looking at a few things. Of course, inflation, I think, is the biggest factor in their own assessment. But apart from that, they're looking at growth conditions and also looking at what's happening globally. So when I look at these three factors, I think growth conditions, if we will look at the commentary from the central bank, they have been very clearly, they're quite optimistic. Their assessment is, we would think, still quite positive on the growth prospect for not only year that ended, but the year that we are in as well, due to various things. I mean, resilience and consumption, they're looking at investment growth, capex through government support. So that's growth conditions. If you look at what's happening globally, the Fed, of course, among other central banks, Fed matters. And what the Fed has said is that they have paused, but they're going to come back and hike at least one or two more times. And the third factor being inflation, which is the most important for us. Inflation is evolving around the projected path. But again, RBI was very clear to mention that among all the factors, inflation, they are still concerned about. They would prefer to be vigilant. That's why they maintained their stance as well, which is withdrawal of accommodation. So I think the steps to follow, I would think, would be first, they would consider changing their stance to neutral before they actually pivot to a rate hiking cycle. And before all of that starts, I think they would prefer to have much more confidence on how inflation is going to pan out. So with these factors in mind, I think early premature pivot to cuts, we don't expect that to happen, at least in the next 6 months. We have a policymeter in house, and when we look at that, it tells us that India is not among the most dovish. There are some other countries like Vietnam, Indonesia, where we think cuts could come earlier, but we are more neutral to hawkish camp as far as India is concerned, and we wouldn't expect a quick pivot to rate cuts. So not a 2023 story from our view.
Okay. Now, my final question to you, Radhika. Last week, we saw some of the agencies like S&P and Fitch. They raised the estimate for GDP growth for FY24. What is your take on that?
I think it reflects the resilience of the domestic economy. I think the economies that are less export reliant and more domestic growth reliant, consumption reliant, are expected to do well, even if we see some dissipating effect from so the pandemic gave a big boost, or post-pandemic reopening gave a big boost last year. This year, that effect is dissipating, but that should be matched with how employment conditions are, how wage growth is. And in those terms, I think in India, our consumption is still quite supportive. Again, for April to June, we could look at many, many high frequency numbers. And it's pretty much telling us the same story, that demand is still, holding up well. And on the investment side, we have seen, capex cycle, especially led by the public sector, or led by the government in particular. I think private sector has deleveraged, it's got cleaner books, but I don't think across sectors or on an aggregate basis, the private sector is still participating very strongly in the capex cycle. So they're still to, go ahead. Capacity utilization rates are still about 70%. And the third leg would be the trade. And I think trade is the one where the risk is the most. Again, when we look at the trade cycles in the region, we've seen quite a sharp correction. I think India's as well, a similar trend. We've seen export growth slow, not only goods, but also services. Like we discussed right at this beginning, there are lower discretionary spends, geographies, as well as some verticals that are doing not so well. So trade part is getting affected, but relative to the weightage of the domestic demand, I think which lends reliance to India's story. And I think that reflects what the multilateral agencies or the rating agencies are doing, which is to raise the growth forecasts. Our own growth forecast is at about 6%. And I think we are holding on to that number as of now. And because we want to see, again, second half of the fiscal year, how does the global growth hold up? Because that impacts our exports, that also impacts our investment cycle for a bit. So we are just, again, somewhere in the middle of the range in terms of the market expectations, and we are holding up at about 6%. In just the overall cycle, I think the growth, consumption-reliant, domestic demand-reliant economies are doing well.
Thank you, Radhika.
Thank you, Shishir.